Cool. All right, well, welcome to today's advanced training. I wanted to have this training just so you guys are aware of some of the ways you can structure policies, specifically for maximum cash value and what's called in industry the infinite banking concept, or become your own banker. For those of you that are not familiar with that, there's a book I highly recommend it. It's called Becoming Your Own Banker by Nelson Nash, Unlocking the Infinite Banking Concept. He's passed away now a couple years ago, but the book is basically all about how you can leverage dividend paying whole life insurance to effectively become your own bank, right? And this is a very interesting concept. He created it, he thought it up, and if you read the book, it basically talks about how with life insurance, and specifically because of the way that the IRS deems insurance contracts, that it allows it to grow tax-free, right? That you're able to put money into it. And then because of the way that you can borrow a policy, take a policy loan against your cash value in there, but it doesn't actually take the money out of your cash value. The cash value actually stays in that account and continues to earn interest. And all it does is they use the death benefit as the collateral for the loan. So if you have a $1 million policy and you have $500,000 of cash value, and they say, you know what, I want to pull that $500,000 out. What happens is that money stays in your account, but they basically say, okay, you can't pull any more out because you used it up. But if you die, that $500,000 is going to come out of your death benefit. So instead of paying you $1 million, we're only going to pay you $500,000. But because that money is still in your account, technically, it continues to earn interest or dividends every year. So you can go use that money to an investment, buy a house, buy a car, whatever it is you want to do, but that money continues to grow in your policy. And then the idea is that you pay yourself back, right? Just like you would if you went and got a loan for that money for whatever it is. And then so effectively you become your own bank. You pay yourself that interest. The insurance company is paying you interest and dividends on it. You pay a nominal, interest on that loan, but you end up making more money. And so that's kind of the whole idea, the whole concept of become your own banker. So highly recommend that. Now, the one thing that I will say is the book, he specifically talks about dividend paying whole life insurance. But this was because, before IULs weren't a big deal, right? IULs didn't come out until like 1997, I think it was. So now that we have index universal life policies that you can actually have higher growth, because you can tie it to an index, IULs are actually really good for this too, because they work basically the same way. The only big difference with the whole life insurance is that for the most part, and if you're working with some of the big, the top 4 mutual companies, they pay dividends like that pretty consistently, anywhere from like 5.5 to maybe 6.25. And right now with interest rates being real low, they're around 6%, anywhere from 5.5 to 6%. But with IULs, obviously you can have a higher return, but that's not guaranteed, right? You can also have years where you're zero. Some years it might be the cap 975 or whatever, depending on the index fund that you put it in. So, but it does work. It does work with IUL. So I want to illustrate that. I'm going to show you guys kind of how that works. One of the things though about when you start to structure life insurance policies is that the software that the companies use, they're pretty robust, and you can have it just do the math for you, but it doesn't always work out the best way. Okay, the insurance company just kind of does the basics, but the good thing is that they're very flexible for the most part, and you can begin to construct or structure the policy exactly how you want it for you or for your client, so that you can try to maximize the cash value that you're generating in there, and so you can pay as minimal insurance, or for as minimal insurance as possible. And so what does that mean? Okay, if you just get a regular life insurance policy and you say, you know what, I want to pay $1,000 a month, right? And if you just follow the software, it'll try to give you, like if you use like, and I'll show you here, watch. if you just use the standard way of calculating this thing and you say, okay, I want to do it for, I'm going to pay $1,000 a month, but I want you guys to maximize this minimum death benefit, maximum cash value. So what does that mean? That basically means is that you want the system to say, I want you to give me the least amount of death benefit where I can put as much cash value into the policy. Because that's kind of the whole idea with infinite banking and structuring policies for max cash value. Most times people get insurance, they want I want the most death benefit that I can possibly get for my money. And some people might want that, and that's okay. If that's the way they want it, fine. Try to get them as much death benefit as they want. But if you're structuring a policy to maximize the amount of money that you can put into a policy, then you want the littlest amount of death benefit that the IRS will allow you to put in there, so that more of your money goes to building up your cash value. And so that's a fundamental difference on how you're structuring these policies. And that's basically all comes down to like your MEC limit. I'm sure you guys all know what a MEC is, right? Modified endowment contract, right? And so the IRS basically says, you know what? In order for this insurance contract to be considered insurance and not an investment, you can only put so much money into your cash value, into your savings, right? If you put too much, then it's no longer an insurance policy. It's an investment. So we're going to tax you on it, and then you lose, right? Because a MEC, you lose the tax advantage. The tax advantage, interest of the policy. So here's where what the government basically says is, if you increase your death benefit, then you can put more money in. And so there's a correlation between how much death benefit you have versus how much money you can actually put into the policy for it not to become a MEC. And I'll show you kind of how that works here in a second. But again, when you have the system do that for you, it doesn't actually work out in your favor if you're trying to maximize the cash value. Let me show you. So I have here a policy. I'm going to change this. So I have $1,000 that I'm going to be putting in a month. Okay. So it's like $12,000 a year. I'll talk about increasing here in a second, but so I just click this, right? When if you do a none, then basically you can dictate what the face value is by clicking this. It only allows you to put in, all right, how much do you want to pay? And then it does the calculation, does the math for you. So go to quick view. And so you can see here, I'm putting in $1,000 a month, $12,000 a year. Okay. And then look at the first year, you're only going to have about $9,000 in your cash value. Okay. And the face amount is about 616,000. Right. But check this out. So really what you're paying for, because here's your MEC premium. This is the most you can put in a year, $23,000, right? And you're paying 12, right? But you can actually put up to 23. So you can almost effectively double this amount that you can actually put into your policy. Now, take a look here. So $12,000 and you only have about $9,000 in cash value. So it's about a 70-30 split, right? Like for every $100, $30 is paying for insurance and $70 is going to your savings account. And in this policy here, you don't break even until about year 6. Well, actually not even year 6. Actually more like year 12. Between 10 and 11 here. So basically at 10 years, you put in $120,000 and then you'll have just about that much. By year 11, you have about $120,000. And that's a big way how you can see how, all right, I'm putting in money, but when do I actually have as much money that I put in my policy in cash value, right? So by just allowing the system to do that, this is not a really well-structured policy. All right, so now let's take a look at how I would probably try to structure this for maximum cash value. So what I would do, I think I already have one here. Let me go back. Illustrations. Let's do this one. So So what I'm doing here is I'm saying I'm gonna get a face amount of 100,000, and this bucket right here, additional protection benefit. What this is, and this is how most people, most IBC agents, infinite banking agents will try to do, is what they do is you're basically buying additional death benefit, but this is priced more like a term. So the cost of the insurance is actually a lot cheaper than if you have a whole life face value here. So let's see what this looks like. You can see I'm putting $1,000. So you see here, I paid $12,000 in premium, but I actually have 11,000 in my cash value. So more money is going into my cash value. And also take a look at this. The other policy, if you notice, the surrender value the first year was $0. So basically you had really no money that you can go and pull out. If I said, I just want to cancel my policy, I want all my money back, or give me as much money as I can get back. So you actually end up having almost $9,000 already in your surrender value. And you actually break even. So here, year 4, you put $48,000. You break even about year 4, year 5. So you put in, roughly 50,000, and by between year 4 and year 5, you already made your money back. Like you already have all your money in your savings account. So this is a pretty decent structured policy. If you notice here, the MEC premium is only up to 13,000. So I'm not paying for more insurance than what I need, right? Because I'm trying to maximize the amount of cash. So I paid $12,000 and I'm getting 11,000 in my cash value versus what, the 9,000 in the other policy, right? So that's kind of the whole idea, is that you're trying to structure the policy so that more of your dollars that you're putting in are going to your cash savings, and you're not necessarily worried about the death benefit. All right. I'm going to stop there. Does anybody have any questions so far? Does it make sense?
Makes sense.
Makes sense.
Okay. So when you start to illustrate, you can play with this. Okay. So, obviously this is $1,000. Not everyone has $1,000 to put in, but if you get into some people that have some money that they want to put it in something that's safe, that gives them a death benefit, and that's able to really start to save and build up cash value and interest, and then pay back interest, this is a good option for them, other than just sticking it in a savings account, right? Because you're also basically not paying for too much insurance. And that's what our job as agents is, to try to educate our consumers, our clients, and structure these policies so that it benefits them, right? Now, let me show you also, I'll just take it back here. One of the things that you have to consider as an agent is that when you structure policies for max cash value, you as the agent have to be aware that you're not going to get paid as much, because they're not paying for more insurance than what they need. So if you notice here, the target premium on this policy is only $1,373, right? So you'd only be getting paid off of that. If you look at the other policy, just so that you guys are aware, let's go here, the standard one. On this one, you'd be getting paid $8,400, or off of $8,400, right? Depending on whatever commission policy you're at. So, because they're paying for a lot of death benefit, 625 of a whole life, right? So that does affect you in your commission as an agent. So you guys have to, be aware of that. You could probably tweak this a little bit. So, maybe this is, not that well for me, and it's not the best thing for the consumer. This is really good for me, but not the best thing for the consumer. So maybe I want to tweak this, right? Maybe you want to come in here and say, you know what? Maybe they don't need 625,000, but maybe they need, I don't know. Let's call it, let's see, 200, and maybe only like, I don't know, 400 or something. Or probably not even that. Let's just double it. 200 of additional death benefit. There we go. Okay, see, it's a little bit better. So they put 12,000 in. They have, you know, 10 over 10,000 in their cash value, plus they have some surrender value. So you're only paying for a minimum insurance, and now you get more commission here, right? So you can tweak this thing, right? They do have $400,000 of coverage, right? And if you notice, I have it increasing, so it's increasing, and only paying into year 65 in this particular case. Now I want to talk about um, increasing option A, option B, increasing or level, right? So if you put level, basically what that means is that your death benefit is not going to change until you have more in or enough cash value that it basically starts to increase at that point. So this basically just says you're only going to get the death benefit if you die. So this extra cash value that you have in here, it's not getting tacked on to the death benefit. So what does that do? What does that mean? So basically the insurance company, it starts to take on less risk as your cash value grows. So, right. So basically right here, let's just say year 14, you have, you know, over $100,000 of cash value. And again, it only has death benefit of 400,000. The insurance company basically says, all right, well, we only have about $300,000 of risk. So the cost of insurance is actually going to start to go down because they're paying for less insurance, right, in case they were to die. So that's important, I guess, you know, early on, you know, depending how you want to structure your policy. But as you start to get further along in years, you know, the cost of insurance actually starts to go up on an IUL policy, right? So you want to be careful with that because you're basically going to be paying for a lot more insurance, right? So the way I structure my policies typically is what I'll do is I'll make it increasing during the early years while the people are young and the cost of insurance is pretty low. But what I say is, you know what, once they hit that point where they're going to stop paying their premiums, so in this case, like age 65, then I'm going to have it change. So this is the year that it changes. And I want it to change and become basically level at that point. So let me show you what that looks like. So if you notice here, right, the death benefit started at $200,000 face value plus the 200,000 of additional. And so basically what it does is it adds the cash value that you have to the death benefit. So it starts to grow with your death benefit. So in this case, your client will get both the death benefit and whatever they have in their cash value. A lot of agents don't know how that works. So, you know, that's why you hear a lot of bad talk about whole life and universal life, permanent life insurance, because, oh, you only get the death benefit, you don't get the cash value. Well, it depends on how you structure it as the agent. So, you know, you want to make sure that, you know, your borrower gets both or your client gets both. But once I get to that point where I'm going to stop paying, you know what, I want to change. I want it to become level now. I don't want to be paying for more insurance than what I need. So if you notice, it does stay level for a certain period, but once your cash value gets big enough, you actually are paying for only a little bit more life insurance. And so the cost of insurance as you get older stays relatively low. Because if you left it increasing, then you'd be paying for that extra $400,000 of life insurance. And that gets pretty expensive, especially when you get into your like 80s and 90s. So be mindful of that. You know, try to structure it the right way so that your client gets both the death benefit and the cash value. So, but again, you don't have to leave it increasing. You can put a change year here of when you want it to now go level. And then, and that way they don't have to pay for more insurance than what they need as they get older. Does anybody have any questions about that?
No.
Okay. Okay, good. All right. So another thing I want to talk about, obviously, if you guys aren't aware of how to illustrate, I'll just kind of go through it just so you guys have a clear understanding. What I can also do, so let's say, okay, I have $400,000 right now. While I'm working, while I'm trying to build up my savings, I need enough death benefits and my family's taken care of. But you know what? Once I have enough cash value saved in there, I don't need more insurance. So what I can do here, I can add a row and I can say, you know what, from the first year of the policy until, while I'm paying my premiums until age 65, right? I think that's when I'm paying. Yeah, age 65. I want to have that $400,000 of coverage. But once I hit age 65, I only need about $100,000. Let's go here. Oh yeah, let's do age 66. So I want to basically reduce the amount of death benefit that I have so that I'm not paying for more insurance than what I need as I get older. And so I can set it up that way in the policy, in the illustration. So once I hit age 65, like my cost of insurance actually goes down really low because I'm only basically paying for another $100,000 of coverage. And that basically just allows me to continue to put money in the policy if I want to. I can, stop paying if I want. But that way I'm not paying for more insurance than what I need. So something for you guys to consider, that you can structure it that way so that you don't need that. Because by that time, look, by the time I stop paying, I could have like $500,000 in there. That's more than enough. Right? I have $900,000 of death benefit. I don't need to have any more than that, right? And it does go down a little bit, but once my cash value continues to grow, then it comes right back up. So you can structure this policy to do that, so that way you're not paying for more insurance, or your client's not paying for more insurance once they get older. And again, the cost of insurance goes up as they get older. And then, in case you guys didn't know, also, you can actually change it. Let's say, you know what, right now I can only afford is like, I don't know, $500, right, of life insurance. But in a few years, I think I'm gonna hopefully get some raises. I'm gonna be able to put more money into it. So you can actually put it so that it goes up or it goes down. Let's say I'm gonna max fund it right now during while I'm making good money, and then later on I don't want to have to put in as much. I just want to put in as much as I can early on, build up that cash value so it starts earning interest faster. But then later on I want to pay less, or in this case, right, I want to pay a little bit initially. I'm gonna, hopefully I'll get better at my job. I'll get a different job, or I'll start making more money. Then I can put more money in here. So you can illustrate it the same way. So you know what, I want to pay for the first 10 years, $500 a month, but then year 11 to age 65, I want to pay more, right? And you can even add more. You can add more rows here and whatnot. So the system's pretty good because it allows you to have a lot of flexibility in how you want to structure it. So you can max fund the policy early on, or you can see, I can only afford a little bit right now, but I do want to have room. I want to structure so I have room to put more money in the cash value as I get more money, my income or whatever, my income increases. So you're able to do that as well. Has anyone structured policies like that where you have changing death benefit or changing premium amounts?
Say that again, Angel.
Have you guys structured so that your death benefit changes, let's say at a certain age, or if your premium amount changes at certain times or certain ages or years? Have you guys structured policies like that?
To be honest, the way that it was shown to do it was really just focusing on the age of retirement. And that's pretty much as far as it went. It was just to make sure that by the time they retire, whether they wanted to continue with putting into both, where they're getting paying. Well, I guess maybe what I didn't understand then, what I understand today, is let's just say that you didn't put a end to the your premium, right?
Right.
So you know how you change your premium from age, from those different years. up until age 65. It wasn't explained, or I didn't understand that it was really where you could do it where you're not putting too much into the death benefit, but you could put more into your cash value.
Right.
That wasn't understood. It was just like, hey, let's make sure that your client at the age of 65 is not going to be, they're not going to have a premium to pay, so that way, they'll be okay. And that was as much as it was explained.
Got it.
So the extra steps that you did here where you're kind of playing around with it, I want more here, I want more there, perfect. I guess it's just finding out exactly what your client wants, but your client's not going to know what they want if you don't know.
Yeah, if you don't know how to do it right and how to explain to them, hey, I can make it so that you're paying more right now, but later on you'll pay less, but you'll build up your cash value, right? So you can kind of explain it that way. Or you can say, you know what, I can design this policy so that you have enough death benefit, right, to make sure your family's covered, but it allows you and gives you the room to put more money into it. So for example, let's say right now, you know what, I just want to put in $500 a month, right? But if you notice, you have room. You can put up to, because of the MEC limit, it's at right now almost 15,000, 14,975. You can put up to 14,975 a year, right? Give or take. So you can structure, say, you know what, Mr. Client, we can structure this policy so that right now you're putting the 6,000, but as you start to, increase your income and you want to put more money in savings, then you have the room to put more into your cash value. So you structured it in a good way that gives them space, gives them MEC space, right? Because if you try to, put more, if I structure this thing so that they're maxed out at 6,000, then they can't put any more than 6,000. So, you basically lock that policy in, and the only way you do this, you have to go back, you have to call the company, hey, I want to increase my coverage, and so on and so forth. Then you can do that, but it's more of a hassle for them, right? So if you design it early on up front for more cash value for them to be able to have the room for more, then you can do that.
So now, what about folks who say, let's just say, for children or parents with multiple children who want to make sure they have coverage, but obviously you're looking at, even if it were the cash value more than the death benefit, how can you structure something where they're only paying, maybe it's $100, or maybe it's 80, maybe it's 75 on the lower spectrum? How much can we give them, especially because you're just playing with the little amount, opposed to 500 to 1,000, you got a little bit more leeway to kind of,
Yes.
make it work for them.
Check this out. So with National Life, the minimum that you can put on the face value is 25,000. But if you notice here, so right here, just so, quick caveat. So you can only put up to 3 times of additional protection benefit than your face amount. So let's just say someone who doesn't have a lot of money, right? They like I said, they can only afford, maybe it's for a child policy. Maybe they can only afford $50 or whatever it is. I can design it so that, okay, they're going to have about $100,000 of death benefit. And let's see here. Hopefully they don't make. So yeah, so you can make it so they can put a certain amount in here. Maybe they don't need that much. I think this is salami. Let's put 50. Okay. So yeah, so you can keep tweaking this thing so that you're trying to maximize the amount of cash value that's going into the policy. Right now, they're paying for too much. You can actually probably kill this thing even more, especially if it's for a child, right? They don't really need that much, but you're trying to give them an opportunity to put some money in savings, right? So you can maybe say, okay, maybe I want to give them 50,000, but they want to be able to put in, I don't know, like I said, $75 or something like that. So you can tweak it. You can make this thing work in their favor as much as possible. So here they're paying like $900 a year, and $537 is going to cash value. So this is not the best one for maxing out their cash value. What you want to try to have it is like what we call it, like a 90-10 split. So for every $100 that they put in, $90 would go to cash value, and $10 would go to insurance, the cost of insurance. And obviously the percentages work out. So you can tweak it so it's about that, like a 90-10 split. That's a good structured policy for maximum cash value. Traditionally, you're going to probably see maybe like a 60-40 split where 60% is going to cash value, 40% is going to cost of insurance. So less money is going into their cash value. So you can design this thing how you want, so that they're putting as much into cash value as possible. So again, I go back to, let's say 25. Let's see, I just want to do this. Let's see what this looks like. No less than 50,000. Okay, so there we go. Yeah, so we'd have to like tweak this thing, but yeah, that's basically it, right? You can design it so less is going to the cost of insurance, and more of it's going to cash value. But yeah, you can play with the numbers and make it. You don't have to pay the high premium amounts. It could work on lower premiums as well. So like for my kids, I got them policies where the max, my MEC limit was about 3,000. That's $250 a month. And that was designed that so I can help like save money for college. But I had a good split, it's like a 90-10 split. So more of the money is going to cash value for them. So yeah, but I designed that for them, and they're only paying until, I'm only having to pay until they're about, I think like 35, 40 years old. And after that, like they're going to have more than enough. And they're several $100,000 after, 30 years from now.
Got it. Thank you.
And then, I don't know if you guys are aware, but you can also illustrate it. So one of the things that the infinite banking concept teaches you is that you can design a policy, right, for max cash value. And I will say this, one thing we need to educate our clients on is that whatever their MEC limit is, like teach them, say, hey, you have the opportunity to save more. You can, like in this one, you have opportunity to put in, $1,800, that's like basically $150 a month, and tell them, say, you can basically maximum fund your policy early on so that your cash value gets big, and then it starts to earn interest faster, right? And teach them, right, the way Rudy has illustrated this, the rule of 72, that compounding interest, how fast your money doubles. Like educate your clients like that so that they know, hey, the faster that you put money in your cash value, the more that you put money in your cash value early on, the more opportunities it has, more time it has to grow and get bigger. So maximum funding a policy is probably the biggest thing that people fail to do. My wife works for Pacific Life, okay? A big insurance company here in the West Coast. She gets clients, I hear the calls all the time where they are not max funding their policies. And by the time they get to the point where they want to start pulling money out, like they don't have enough in there because they didn't max fund it. They're paying for more insurance than what they needed to. And then all of a sudden the cost of insurance starts to go up. So it starts to eat away at all their cash value. So educate your clients. You guys, the most important thing about policies is that you have to max fund it early on. Put as much money as the government allows you, as much MEC limit allows, so that it starts to earn that interest early on. And that way you don't get into a situation where, you're 65, 70, 80 years old, and you now all the money that you've put into it is basically getting eaten away by the cost of insurance, right? So it's very important. We don't want to put people in a bad situation because, that's our reputation too, as a company, but you as an agent, as an individual. And that'll also help you like educate them and tell them, hey, like this is a real opportunity for you to save money and start to earn it. But if you don't do it the right way, later on, it's going to come back to haunt you. So, just be mindful of that.
Now, does the MEC premium include the premium, like the monthly premium?
So this right here is basically the government's like limit. They tell you, hey, this is the most that you're allowed to put into your policy. pay towards your policy before it becomes, you know, a modified endowment contract, but the government says, hey, it's no longer an insurance, it's an investment. So the insurance company is good. They won't let you put more than that. They'll actually send you a check back and say, hey, or they'll call you and be like, hey, you're about to become a mech. Are you sure you want to do that? You obviously say no, and then they'll send you back whatever overage you paid into it. But that's the government's amount that they say, based on your death benefit, that's the most that you can pay towards your policy in 1 year. The other thing is obviously your guideline single premium. This is the total amount that the insurance company and that the rules basically say that you can pay within 5 years on an IUL. So if you try to put more than that within 5 years, it'll adjust it and it'll tell you, no, you can't put more than that within the 5 years. It's basically the most you can fund a policy within 5 years. On a whole life policy, like your mutual trust, it's the guideline single premium is within 7 years. So I don't know why IULs are 5 years and whole life is 7 years, but that's just how the rules are. So that's the most you could actually pay towards a policy within 5 years also, so it doesn't become a mech.
So is it like one or the other? So you should say, because your mech is 18, right? And if your single premium, your guideline is 93 within 5, are you,
No, it is separate.
you're able to put in
71 times.
so it is
Yeah, you know
separate.
what? It's actually pretty much the same, because if you multiply 1,871 times 5, it comes out to 9,355. So they're roughly the same. Right?
Okay.
This just basically tells you how much you can put in 1 year, and this is overall within 5 years. That's the most you can pay.
Okay.
Okay. So yeah, so this is basically right. So structuring for maximum cash value, right? Play with your numbers. I would highly encourage you guys to come in here and start playing with this thing, so you start to understand. So when you get in front of a client and they start to tell you, okay, I want to pay this much, or that's the most I can afford, then you can start to structure the policy so it's trying to max out that as cash value, right? But don't just go with the minimum DB max cash value here, because you guys saw that doesn't actually work out in their favor. Now, I want to talk a little bit more about the infinite banking concept and kind of how that works. So let's say you have a policy, and I'll go back to the one I was using, illustrations. Okay, so the way I have this policy structured, right, I'm paying $1,000 a month, max, trying to max it out as much as possible. But let's say I want to buy a car, okay? And look, all of us buy cars. You know, as part of like what I teach my financial coaching clients is like, hey, pay cash, don't go refinance a car. Like, you know, it's stupid to have a car payment. It robs you of your future because you could be using that money to invest and so on and so forth. So I tell people, hey, save your money and go pay cash for a car, right? What you can do with these type of policies is very interesting, right? All with the concept of becoming your own bank. So let's say after 5 years, I have about, you know, $60,000 saved in here in my cash value. And so, you know what, I'm going to go buy me, I don't know, $30,000 car. I'm going to tell, hey, Mr. NLG, I would like to take out a policy loan for $30,000. So I'm going to go pay for that car cash, right? I pull out that money, and, you know, that'll reduce, you know, the death benefit, but that money, this 59,000 stays in here, right? It's still going to keep growing and gaining interest. And so what I'm going to do is I'm going to go pay that $30,000 cash. And then, like I would probably normally do, I'm going to save for another 5 years or so. And I'm going to be putting money into in a savings account like normally. And instead of going and borrowing to buy a car, I'm now going to make that car payment and pay off that loan. I'm going to pay off the loan in my insurance policy. And it's going to continue, the money's going to continue to earn dividends or interest. And then after 5 years, my account will be whole. I will have paid more into it, right? I would have paid myself a little bit more in interest even. I could charge myself some interest. And then I'll be back to zero of borrowing against my policy. So now I'm going to have all my money back plus more because it's been another 5 years of growth. And so I'm basically becoming my own bank. I'm paying myself that interest. Like I borrowed, I went and got a loan for a car, but I got it from myself. And so if you guys read that book, Becoming Your Own Banker, that's basically what it teaches you. And all of a sudden, you now become your own bank. You don't have to go and ask someone, fill out an application, and go beg the bank to, lend you some money. You take a loan against your policy, and you pay yourself back. That's the number one concept about becoming your own banker, is that you are effectively becoming the bank, and you're paying the bank back. So you pay yourself back with interest. So it's a very lucrative thing. The moment I found out about this, I started reading the book. I couldn't stop reading it. I was like, this just can't be true, but it is. That's just how insurance policies work. So, let's say you have some money in here. Let's say you have 100,000, 200, 300,000. You can go borrow against that. Go, I don't know, fund a business, go start a business venture, go buy some real estate, have that money make you money. But the money in your cash value continues to earn you interest and dividends because it's still in there, right? And then once you've done either making that money back from your investment or whatever it is, that business venture starts paying you back, and you just start paying off that loan. And now you use that same dollar twice. It's making you money in the insurance policy, and you used it in your investment for it to grow, and it made you some more money. So you can just start basically using those dollars multiple times, and now your money is making you more money. So it's a very interesting concept. I would encourage you guys to kind of read into it for yourselves and think about that. But if you do have an insurance policy, max fund that thing and use it, leverage it so that your policy starts making you money, and you don't have to go ask someone else to borrow money to buy a car, buy a house, or whatever it is. So I did want to kind of touch on that because that's a very interesting thing for whole life policies or policies that have a cash value element. Does that make sense? Does anybody have any questions about that?
No, makes sense. Thank you.
Sorry, Kool-Aid, if you're, I think you're unmuted if you want.
So I do have a question. So I do understand that other policies have their own limits to taking out some money, like borrowing money from their cash value. How soon can a client take out or borrow money from their cash value?
The moment it's in there. I mean, it's like if I were to put in, $1,000, or like in this case, I can put up to 13,000. If I went and put $13,000 in there, like in a few days, I could go ask the insurance company to give me a loan on that. Like it's that fast. The moment they process it and the money's in there, then it's yours. That's your money. It's your cash value. It's your savings.
Awesome.
So,
okay.
And from what I've heard, and I haven't done it on NLG, but if you request it from them and just do a direct transfer into your bank, you can effectively have that money wired to your bank within a couple of days.
That makes sense.
All right. All right, cool. So this is, obviously I'm using NLG here. I did want to pull up Mutual Trust because I know this is one of our preferred carriers that we want to start to leverage a little bit more. So I want to share this with you guys just to kind of show you what it looks like. I don't know if you guys have had a chance, if you guys have become approved with them and are able to start illustrating, but this is their illustration software, okay? It's a little bit trickier, but it's kind of the same thing in a sense. I'll kind of explain a little bit, okay? And we can get them to actually give us training from their side, from their perspective of how to properly structure and what all these things mean. So if you guys want, Rudy, if you want me, I can help schedule that with Justin over there. So this is basically, the illustration software. You put in the client's information here. Obviously, you put their age and whatnot, male, female. And then you go to plan design, okay? So in this case right here, it starts out with $100,000. And I think the lowest you can do here for their whole life product is $20,000. That's the lowest. So that would be like kind of like their final expense product. They do have different policy types. There is they call the Horizon. There's the Horizon Guaranteed, which basically pays a little bit more in dividends, but it's not designed for maximum cash value. There's the Horizon Blend, which basically says it's kind of like a mix of the two. It gives you a little bit more cash value or ability to generate more cash value, but it's a little bit more guaranteed as well of the dividends. We're talking about the dividends. And then there's the Horizon Value. This is the one that's for structuring it for max cash value for like infinite banking and whatnot. So the way this typically starts out is like this. You have a level face amount design. You can do it so it tries to automatically calculate for you, but I'll kind of show you guys what this looks like. I'm gonna go level flex pay. And for a whole life policy, the way that they do it for you to try to maximize the cash value and pay for minimal death benefit so you can put more money into your cash value, they call it paid up additions, your PUAR, your paid up additions rider, okay? And I'll kind of show you how that works. So right now I have $100,000 of just permanent insurance, but I can go here to riders, and under here, primary 10-year rider, double click that, and I can add basically term insurance, okay? And remember, term, because it's only for a certain amount of time, it's not permanent, it's not for the rest of your life, it's much cheaper. So you can add death benefit so that your MEC limit goes up, and it allows you to be able to put more into your policy to maximize the cash value, right? So that you don't break the IRS rules and everything. That's basically what it's all about. So in this case, I have a $250,000 of additional death benefit, basically, up to age 65. And then, so what that does is that it now allows me to add more money in my premiums. So right here, this flex pay paid up additions rider, how much do you want to pay? This is monthly. So of that $1,000, I want to pay, I don't know, let's say 800 of that. I wanted to go to my paid up additions for that additional death benefit. And this is mostly going to go to cash value. So I can click run here. Does the calculation. And then when it starts out right here like this. It just starts like this. You'll see it like this. And then you can kind of go through the pages. This tells you here, this is the additional death benefits. There's the 100,000 plus the 250 additional. Like 800 of that $1,000, like 979 is the total premium. But you're basically paying for additional death benefit here. So 800 of that is going towards this paid up additions rider. Right. And then you guys can see here, these are just the basic illustration pages. So this is the total amount that you'll see, that $1,000, give or take, is about 666. And this kind of gives you the breakdown. So you're basically going to get paid off the base policy. This is kind of like the standard rate, and then you'll get paid a smaller portion on the paid up additions as far as commissions goes, because most of this money is going to the cash value, so you won't get paid as much as you would just the base policy amount. So something to note there. So this is how this works. So they guarantee a certain amount of dividends. So after 5 years, you would have paid 58,000 in premiums, but you'd only have about 52,000 in cash value. Okay. The illustrated side, where they're showing you the higher amount of dividends that might be paid out, you'd have a little bit more. After 20 years, you would have paid 237,000 into it, give or take, and you'd have about 300,000 in cash value. So again, we can kind of go through this in more detail, maybe in another session. I know we're kind of coming up on time. I did just want to show it to you guys. So if you guys haven't started illustrating with mutual trust, you want to definitely get familiar with how to use this thing, how to properly structure it. Kind of the same things. You have the guaranteed side, and then you have the the non-guaranteed illustrated side here. So your cash surrender value, you can see it starts going up. You paid $11,757. You'd have about $9,000 in cash value. So this is roughly about a 75% split. One of the things that with whole life is that they don't pay necessarily interest, right? It's not tied to an index fund like the way an IUL is. They just basically pay dividends. So mutual trust, right? It's a mutual insurance company. Whoever has a policy, the policy owners are actually the owners of the company. And so as the insurance company makes money, as they invest their money, as they give out policy loans and they're collecting interest on the policy loans, then that's basically the money that gets paid back to the policy owners in the form of dividends. And so that's basically how your cash value grows. Mutual trust says that for over 100 years, they've paid dividends. And right now they're about 5.65, I think, is about the rate. So it's not a lot, but it's virtually guaranteed. And you can't say it's guaranteed, you know, to your clients, but for us, I mean, we kind of basically know that you're going to get a minimum of about 5.5% on the money that you have in there. Now, you're kind of limited, right? That's not a lot. That's not a lot as far as returns coming back to your money. That's why you'll hear a lot of investment gurus and people out there like the Dave Ramsey's of the world. Oh, don't get whole life because it's not good. You don't get enough back, but it's pretty safe and your money is growing, right? It's enough to cover the inflation and you'll get some extra. So just something for you to consider. I have not sold a whole life policy. I've been focusing on IULs just because the potential for additional returns is there. So that's why I've been kind of pushing the IULs, but this is a good option. On top of the fact that, you know, they're a good partner, they are paying us, you know, a good amount of commission, is the highest commission that we'll get. So I know Rudy and team want to start, you know, being able to send more business to mutual trust. I mean, it's a good product. You obviously, you can tailor the policy for max cash value, the same thing like the IUL, and, you know, your clients can get a good solid product. But just that's something that's definitely different from an IUL, is that it's pretty much capped out at about, you know, 5.5%, 6%. All right.
Hey, Angel.
Yeah.
And I had a question in regards to the MEC. Will the MEC change over the years?
No, unless you change your death benefit, right? Because you can change your death benefit whenever you want. You can call the insurance company, hey, I want to reduce it, I want to increase it, or they can call you as an agent. But yeah, that'd be the only way, is if you're changing the death benefit.
And just to clarify, when we're pulling out, as far as the cash value, if you're pulling it out before a certain time, there still are, even if it's a loan, aren't we paying? Isn't there a penalty for pulling out or loaning? No.
So, okay, so let's talk about that. There are 3 ways to get money out of an insurance policy. There's a sad way. Basically, you die. If you die, you're going to get the money out. Don't recommend that way. The second way is not the smartest way, and that's just if you withdraw the money. Okay, not a policy loan, but just withdrawing the money. Okay, and the way insurance companies work, it's what they call FIFO, first in, first out. So the money that I put into the policy, my basis, the cash value of the money that I put in, not the growth that's happened, I get that money out. So if I put in $500,000 over several years or whatever it is, and I start to withdraw that money, then it's not taxed. There's no penalty, okay? Now, if you surrender your policy, there is a penalty. The first 10 years, you'll pay surrender charges, right? Which is why if you look at, if you go back to NLG, you have the cash value, but then you have the surrender value. So if I go and I say, you know, I just don't want this policy anymore, I'm going to have surrender charges. So I'll only get this much, right? But after 10 years, if you notice, year 10, I have 138,391 of cash value, and my surrender charge is roughly the same. And after that, like, there's no surrender charges. So that's basically where you will have fees if you pull money out. Now, the third way of getting money out, not a withdrawal, right? But a policy loan. You can pull that policy out. Now, what you will be charged is interest on that loan. But the way the insurance company charges interest is not like a mortgage loan or anything like that, like a car loan. It's actually simple interest. What does that mean? If I pull out, let's say $100,000, and let's say the insurance company charges 5%, right? Just to talk. That 5% is 5% for the whole year. So it's $5,000 flat for the whole year, or however long you had that policy out. Let's say I only need it for a few months. They would only charge you that interest for those few months. And so the way they calculate the interest is daily. So they'll take, okay, $100,000 over 365 days, or that $5,000 over 365 days. So the cost of that policy is maybe $1 a day kind of thing, or whatever it ends up being. So that's how they charge you interest, simple interest, and it's daily. So for however long that you have that policy outstanding, that's how much it charges you. So that's the only fees that you're going to get. But consider this, right? So let's say I pull out $500,000, right? Or let's say I pull out $100,000, they charge me $5,000 of interest for the year. But remember, that money's still in your cash value, growing. So let's say you got 9% from the index fund, right, that got credited to your account. So you got $9,000 back. They charged you $5,000, so you made $4,000 of interest, but you're using that $100,000 for whatever you want. So like it starts to even out, like eventually, which is why you can start to pull out money for income benefits, right? You can start pulling that money out and it doesn't run out because the interest starts to compound and make you even more money while you're pulling that little bit out for the income. Does that answer your question?
Yes, thank you.
You're welcome. So you know what, that's a good point. I know we're kind of up on time. I am mindful of you guys' time, but real quickly. So I know that a lot of people push the income benefit, lifetime income benefit. Okay. And this is good for people that aren't putting a lot of money into a policy. But I want to show you guys kind of what that looks like, right? So let's take a quick look at this. So let's say I start to take the lifetime income benefit rider at age 65, right? I have $886,000 in there right now, give or take, by the time I hit that point. Let's say, okay, you know what? I want to start to pull out, I want to activate the lifetime income benefit rider at age 66 or age 65. Let's see, does that work? Yeah, I think it's age 66. Okay. So I'm gonna go back here. So I start to activate that. Notice that, look, you had $886,000 in here. And automatically now they're gonna start paying me out about $40,000 a year. But look at how much it reduced. $220,000 got my death benefit got reduced, but I only pulled out $40,000. Why is that? Because the way that they're calculating it out is it goes all the way to 120. And then eventually you'll never run out of money, right? That's kind of the whole idea. No matter what, you're at the very least, your family will have $15,000. But if I do it a different way, I can illustrate it like this, I say, you know what, I don't want the lifetime income benefit, but I'm going to specify an amount. Starting at age 66, I'm going to pull out $40,000, okay, until I die. So you can see that you can start pulling it out and it doesn't bring it all the way down. Actually, why does it do that? So I had another policy where I did it and it was actually allowed because I didn't max fund this one. But you can see like you can start pulling out the cash, the cash from here, but it continues to grow, right? So I would be mindful of that. I would play around with this so that you don't run out of money. You might have to tweak this a little bit so it maybe grows. Maybe you don't pull out 40,000 right away. but it's something to consider. That lifetime income benefit rider doesn't always work out in your favor. So you have to kind of play with it and see, is it better for me to maybe take out a little bit at a time and it's, let the money keep growing without activating that lifetime income benefit rider. So something to just consider about that.
Yeah, I've seen that happen. Now with the when you're pulling out that 40,000, that's 40,000 a year, right?
Yes, this is for the year.
Okay.
Yeah. You can also make it increasing. I don't know if you've seen that before. Or you know what? Initially, I wanted to start out just giving me. I wanted to increase the payout as it starts to grow, right? So I can click this. I can make it so it doesn't reduce the face amount. And right, so it starts out paying you 27,000, and it starts to grow as you get older, right? This will help with inflation, and again, it doesn't run out of money. So something to consider. So you can play with this thing and obviously make sure it makes sense for how you've structured the policy for your client. In some cases, lifetime income benefit rider might be the way to go, but if they haven't put enough money in there, if they haven't max funded it, then this might be like, I've seen some where you're only going to get paid like $300 a month. Like, you know, you're going to get like 3,600 for the year. I'm like, dude, that's not enough to live off of. You know what I mean? So this is where educating your clients to max fund their policies, put as much money as you can so that when you are ready to activate that lifetime income benefit rider or start pulling money out through policy loans, then you're not going to run out of money, and it'll last you at least through age 100, you know? So that's something for you guys to kind of play around with. And obviously every policy is different. Every client is different. You have to really understand their needs and what's the best thing for them. But just, it's all about you understanding how this software works, how you can illustrate it so that it makes sense for them, for their specific situation.
Perfect.
All right, guys. Any other questions? Rudy, do you have any questions or anything, any comments?
No, I'm good here.
All right. Thank you.
I'm good, brother. That's a lot of information right there. A lot of valuable information. First time I get to say these, I get to learn something new. That's beautiful. You don't hear me saying that a lot, but I love it. I'm glad you're recording them. Share the video, whatever. Later on, I'm not sure how you're gonna do that.
Yeah, I can do that.
Yeah, I'll share it because there's definitely a lot of information, especially when it comes to illustration, so people can go back and look at it to do some certain adjustments there. So that's pretty cool. But anyways, Angel, thank you for your time, everybody. Glad everybody connected. Well, this is a lot of great information, and this is how you practically take care of wealthy people. Remember, wealthy people, the wealthier the people are, the more taxes they pay. So you always got to take care of the wealthy. If you can offer a tax-free retirement strategy, they'll take it. They'll take it. Wealthy people will take it. Remember, the more value you provide to them, the more you're earning. Okay.
Yeah, and I mean, obviously, this is where the LERP really comes into play, right?
Yep.
Life insurance, retirement planning. You might also hear it called a TIFRA, a tax-free retirement account. I like to call it a FIRE fund, a Financial Independence Retire Early Fund. That's what I call it.
Wow.
But yeah, if you guys ever have any questions about how to structure something, or you're just kind of playing with it, you know, you can feel free to reach out. You can reach out on the group me or yeah, anywhere. Call me, send me an email, whatever it is. But I appreciate you guys your time. Thank you for listening, and yeah, look forward to for us to like grow this stuff and structure policies the right way for max cash value.
Awesome. Thank you, Angel. Appreciate it.
Thank you,
Everybody,
Angel.
God bless you. Have a
God
wonderful
bless.
rest of the day. Okay. Bye-bye.
Thank you.